The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and welcome to Your Money, Your Call. I'm Julia Lee. Well, it has been another volatile time on the markets. We've seen some of the systemic risks dying down, but now with the low growth environment, we haven't seen shares doing too much at all. If you've got a question about shares, now's the time to give us a call. Our phone lines are open and the number's just on your screen there, 1300 30 34 35. Or if you prefer, you can also email us on yourmoney@skynews.com.au. Tonight on the panel, I'm joined by Michael Gable from Novus Capital and also Tim Kelley from the Montgomery Fund. And let's start by asking both these gentlemen what they think about the market and where they think it's headed for the rest of the year. I mean, Tim, you manage funds, and how much of it is in cash at the moment? Are there particular areas of the market that you're interested in and particular areas that you're avoiding?
Julie, we have quite a significant amount of client funds in cash in one of our funds. In another of our funds we're more fully invested, so it depends a little bit on the product. I think to come to your question in relation to where we think the markets might go from here, we don't claim any special insight into where markets might go in the short term. And if you look into the research into economic forecasts, it doesn't give you a lot of confidence that economic experts have great insight into where economies are going and what that might mean for markets. What I do think is a good principle for investors to keep in mind is that in the long run, equities have proven to be a very, very attractive asset class, provided you can take a longer term view and absorb some of the short term risks. And a really useful principle, I think, is to try to be invested in equities at a time when they offer relatively good value. Do they offer relatively good value now? It's not easy to say with any certainty, but one thing investors, I think, can look to are simple measures like PE multiples and dividend yields across the market as a whole. And if you look at those measures now, what you'll find is that the Australian equity market appears to offer reasonable value. And we think it's a good time to be looking for high quality companies that are trading at a discount to intrinsic value, because there are certainly some opportunities out there to be found.
Okay, so lots of opportunities on the market, and we're hoping to talk about some of them tonight. We actually have our first caller on the line, so welcome to Brett from New South Wales. Brett, welcome to the program. What's your question for our panel tonight?
Oh, hi. Mine's regarding Sedgman. I realise being in mining services, they've all taken a bit of a hammering in their share price. But I'd like a technical and a fundamental on Sedgman. And if Tim doesn't mind, if he has a quick second, just to give me an intrinsic value and a rating on Cabcharge as well. Thank you.
Sure. So we're looking at two companies. We're going to start off by having a look at Sedgman. SDM is the code, and we have seen the shares, of course, coming under pressure. Now, this company has been around for a very long time, since 1979. And I guess in terms of its actual business, it's well known for its coal processing and materials handling technology, and of course that's been one area which has been sold down very heavily. Tim, coming to you and having a look at Sedgman, and this is a company that has strong exposure to both thermal as well as coking coal, but not too capital intensive from a fundamental point of view. What do you think of the valuations and also the outlook?
John, in relation to Sedgman, it's one of a large number of companies that are exposed to the resources sector, for which the intrinsic values look very good, and there's any number of these businesses which, if you calculate the intrinsic value, you get a number which is significantly higher than the current share price. At Montgomery Investment, we've struggled to bring ourselves to be investors in a lot of these businesses in recent times, though. And the reason for that is that they tend to have a fair bit of operational leverage. So when times are good, they do very well, and you see that reflected in strong earnings results. And the forecasts provided by brokers tend to imply that growth will continue. When times get tough, the businesses can suffer pretty quickly. And what we've seen recently is a period where the resources companies have enjoyed really attractive prices for their commodities. And they haven't really cared too much what it costs in terms of the services that they procure from various service providers. Looking forward, if you're less confident about resources prices, then you have to think that the margins for some of these clients will get squeezed, and one of the things they will do is they will look to the service providers like Sedgman and put them under a lot more pressure in terms of prices, and we're likely to see a fair bit more competition emerging. For us, valuation looks good, but there's a lot of uncertainty around that valuation, and we're sitting back for the moment waiting for a bit more clarity around how the industry dynamics might unfold.
So, Tim, looking at the mining services industry, and you don't really like Sedgman too much, what mining services companies are attractive? Are there any out there, or are you avoiding them altogether as a group?
We're avoiding the majority of them, Julia. One that we do like is Decmil. And Decmil is one that we like, partly because we think it's very well managed, partly because its exposure is oriented more towards energy, which we think has a more favourable supply and demand outlook for the next little while. And just coming back to Sedgman, I mean, it's a business that has a lot going for it. On scaffold, it rates as an A1 business, and the valuation does look good. It's more that there's a level of uncertainty there that makes us uncomfortable committing our clients' funds to some of these businesses just at the moment.
So, I mean, Tim, looking at Cabcharge, it's just paid its dividend. It's got an attractive yield of 6.6%, but you're waiting another 6 months for another dividend. Would you be investing in this company for growth as well?
The answer to that is no, Julia. The thing with Cabcharge, it has been a great business. It pretty much invented the taxi card payment systems, and essentially every taxi in Australia has a Cabcharge terminal in it, and if you pay a taxi fare using a Cabcharge card or any other sort of a card through a Cabcharge terminal, Cabcharge get 10% of your taxi fee, and that has been a great business for them, and when it started they had something close to 100% market share. The issue for Cabcharge is that there are now competitors available to the cab drivers. The Cabcharge system is installed in essentially every cab, but the competitors to Cabcharge provide the taxi drivers with a terminal that they can carry around with them. If the taxi driver uses that terminal instead of a Cabcharge terminal to process your payment, then the taxi driver gets to keep 3 or 4% of the 10% that Cabcharge take. And what that has meant is that Cabcharge's market share has been steadily declining, and we can't see any reason why that decline will abate, given that it's more attractive to the drivers to use the alternative system. So while the valuation on historical fundamentals looks pretty good, we think market share will continue to decline, and for that reason we're not investors.
Okay, so Tim doesn't like Cabcharge, saying that new technology is really eating into its market share, and some of the technology just amazing. I was catching a taxi the other day and they pulled out their mobile phone with a chip and wanted my card. So certainly new technology, not good news for Cabcharge and the old monopoly model that they've had. And Michael saying that it looks like it's in for a 10 to 20% pullback. So if you're interested, probably buy on those pullbacks. Let's go to our next caller. We've got John on the line from Queensland. John, welcome. What's your question tonight?
Hello, Julia.
Hi.
I'm very pleased to speak to you tonight. I've been a long-term investor, probably 50 years, but for the life of me, I can't advise my son on a growth stock to put his $30,000 into. He's single. Looks like he'd like to keep it going for about 5 years.
Sure.
And I just want the panel, including yourself, Julie, if you wouldn't mind,
Sure.
to give me 1 or 2 stocks which you'd put your life on, and just see what happens over the next 5 years. Maybe I won't be around, but he can hold you to it.
So John's looking for a stock portfolio for his son, who has about $30,000. Now, we can't really give individual specific advice because we don't know too much about your son, John, but generally speaking, for a younger person who does have a longer time frame to invest and looking at growth options on the market, hopefully we can give you some ideas. And we might actually go to Tim first on this one. So looking at growth options over the next 5 years, what are some stocks which catch your interest?
Okay, I think if we come back to first principles on this, if you plan to hold a stock for a really long time, I think one of the best things you can do is own a stock that has a high return on equity. And what that means is that reinvested profits earned by the business are earning a high rate of return. And over time, a high return on equity leads to a strong return on investment, because the amount of reinvested capital going into the company grows over time. And if you're getting a good return on that capital, you can't help but do well. High return on equity to us typically means finding a company that has a clear competitive advantage, something that will allow it to continue to earn a high return on equity despite the efforts of competitors to make inroads into its markets. And to give an example of a company that enjoys a good competitive advantage and a good return on equity, Cochlear is one that springs to mind. It's a company that delivers a great product and has a lot of opportunity ahead of it, so I think it's one that you could hold for the long term.
Any other stocks which get your interest at the moment, Tim?
One area that I think is probably worth mentioning is some of the internet stocks, which have been fantastic performers over the last reporting season. And one that we like in particular at Montgomery Investment is Seek, which dominates the Australian online job advertising market. It has a market share several times bigger than its nearest competitor. And that business is one that will benefit from a continuing structural shift from print to online advertising. Looking longer term, though, we think Seek is particularly interesting because it has investments in 9 Asian and Latin American countries, and in each of those cases it has the number 1 or the number 2 online jobs board. And those investments are in countries where internet penetration is not as advanced as it is in Australia, and the structural shift is not as advanced. But if Seek is able to hold on to a leading market position in some of those markets, the potential is fantastic. The GDP it's exposed to through those investments is something like 20% of world GDP, as compared with 2% in Australia. So that's one that's potentially very interesting long term.
So John, I hope that helps you out. Plenty there, and I'm sure we could spend the whole show talking about our favourite growth options on the Australian market. Let's go to our next caller. We've got Robert on the line from New South Wales. Robert, welcome. What's your question tonight?
Yeah, hello, good evening. I'm inquiring about gold and silver bullion.
Sure.
And what do they think of the rise on silver over the last 5 years?
So having a look at silver and gold and the rise that we've seen over the last 5 years, and I guess the question might be sort of what's the outlook for gold and silver at the moment. So positive on gold and positive on silver, which they usually call the poor man's gold, and I guess part of that is because of, well, a lot of that is because of quantitative easing. Traditionally, we've seen the demand side coming from jewellery demand, either from China or from India, but at the moment we're seeing a lot of central bank demand. In the last few years, we've seen central banks being net buyers of gold for the first time in a few decades. I mean, Tim, do you like the gold story, and how would you gain exposure to it?
I think it's probably appropriate to acknowledge that gold is one of those very divisive topics in finance. There are people that seem to either love it or not love it. And even within Montgomery, we have a healthy debate as to the merits of gold. From my point of view, I struggle with gold, and the reason I struggle with it is that I don't know how to value it. With an industrial commodity, you can understand from cost of supply and the industrial uses and the demand what the value of that commodity should be. With gold, you can point to the factors that might drive the gold price higher, such as money printing, quantitative easing. You can point to the factors that might drive the gold price lower. But the issue for me is that it seems to be impossible to work out what the gold price should be and whether those factors have already been priced into the current gold price. The principle that we try to follow is we invest in things where we have a high level of confidence that their value is greater than what we're paying for them. And in the case of gold, that's very, very difficult. For a gold company that's making profits, you can get comfortable that provided the gold price doesn't fall too far, that company will be valuable. But in terms of buying bullion, while there are great arguments in favour of it, it's something that I personally struggle with.
Let's go to our next caller. We've got John on the line from New South Wales. John, welcome. What's your question tonight?
Hi guys, thanks for taking my call. I'm a long-term holder. I've been holding my portfolio for a while, and much like everyone else in Australia, I've got some commodity stocks in there. I just want to get the panel's thoughts. It's a bit of a broad question. The Liberal Party has talked about recently the scrapping of the mining tax and the carbon tax if they were to get into power. I just want to get the panel's thoughts on, number one, do they think that's actually possible for them to scrap those taxes? And two, their outlook for mining stocks going forward if that were to happen, or in fact if the Labor government was to stay in power.
Okay, sure. The question was regarding the mining space and the effect that a change in government would have on that space. So we might go to Tim first on this one. I mean, we're coming up to an election. It shouldn't be too far away, probably looking at in 2013. Is there a preference in terms of political parties for the investment environment for mining stocks?
I'm going to duck the question a little bit, John, and perhaps talk about our approach towards mining stocks, because we're not the best or the most active investors in resources stocks. And the reason for that comes back to this principle that we like to invest in things where we're confident that what we're paying for a stock is less than the value of a stock. And in the case of resources businesses, there are so many uncertainties. You've mentioned some of them. Commodity prices and exchange rates are probably the biggest ones. And it's enormously difficult to have much confidence about long-term commodity prices, which means it's enormously difficult to have confidence in the value, we think, of a resources business. And so it's less often that we find businesses like that we're happy investing in.
Okay. And we've got Andrew on the line from the ACT. Andrew, welcome. What's your question tonight?
Yeah, my question, Julia, to the panel is, as a current IAG shareholder,
Sure.
I've been pleasantly surprised by the performance over the last sort of 3 to 6 months. I was just wondering on the panel's outlook for that stock over the next, say, 6 to 12 months.
Sure, so having a look at Insurance Australia Group and the conditions for insurers, a lot better than we saw in 2012. Not a lot in terms of huge catastrophic disasters. And also we've seen insurance premiums holding up fairly well. The reinsurance business, which we thought would add to higher costs, that hasn't really materialised. Tim, in terms of the fundamentals, what are you seeing? Is this a stock that you'd be happy with, or is it looking fully valued at these levels?
IAG is not a stock that's brought itself to our attention on the basis of its fundamental valuation. Its value has improved quite significantly in the last little while, and I think that's reflected in its share price performance. Where it sits now, we would put a valuation on it that's slightly below the recent share price. That valuation, we think, it has the potential to increase in coming years. But with the share price where it is now, it's not a stock that we think is particularly attractive on valuation grounds.
Okay, so Tim, not supporting Insurance Australia Group, the stock has done fantastically well, up by a massive 50% over the last 52 weeks, so it's increased quite phenomenally. Let's go to our next call. We've got John on the line from WA. John, welcome. What's your question tonight?
Good evening and thanks. Could I please have the panel's insight on Resolute Mining and Magellan Financial Group, and a point of entry for both, please? Thank you.
Sure. I know Magellan Financial Group been doing very well. Magellan Financial Group, MFG is the code. I mean, most fund managers have been struggling over the last couple of years. This isn't one of them, Tim.
It's not one of them, and I need to start with a bit of a disclaimer here, because Magellan actually has a shareholding in Montgomery Investment Management. We know the guys very well, Hamish Douglas and Chris Mackay. And we have enormous respect for them. I think Hamish Douglas is just doing a fantastic job at Magellan. They invest globally, and their results have been impacted by the fact that they don't hedge their currency exposure, but on a constant currency basis they've been just doing a really, really excellent job with their investments. As to buying shares in MFG, I think if you're constrained by valuation, as we are, it's very, very hard to get to the current share price. But I can't stress enough that it's a very, very well-run organisation with very, very good guys and very, very good procedures, and I'm sure that they will continue to be successful. We think that over time they will probably emerge as a genuine challenger to platinum.
Okay, so Magellan Financial Group, I mean, an amazing performance over the last year, up a massive 190%, which is amazing for a fund manager. Let's go to an email now. We've got one here from Michael, and Michael asks, wondering what your opinions on graphite players are, specifically AXA and Syrah. I mean, graphite, I think of pencils when I think graphite, but actually it's used in a lot of products, automobile products, brakes. I think it's used in lithium batteries as well. Tim, what do you think about this?
Look, I think one of Michael's comments resonated particularly with me there, which is that you've got to be prepared to lose all of your investment. That's not to say that you will. These may turn out to be very, very successful, but they're loss-making at the moment. There's clearly development risk on top of the commodity price risk and the other issues that need to be considered. We're unable to assess the value of these sorts of businesses, and so it's not something that we can shed much light on, I'm afraid.
Okay, it's time to start the stopwatch, and this time we're going to go to Tim. So Tim, what are you watching?
Macquarie Telecom Group is one of Australia's leading managed hosting providers, and in the last few years it's invested quite heavily in building some very efficient, very high quality data centres, the second one of which it recently opened in Sydney with News Limited as a major tenant. Macquarie Telecom Group shares have been a great investment in the last few years, and we think it remains a very high quality business at an attractive valuation.
And we've got an email here from Mark, and Mark writes, what are your thoughts on Goodman Group? I bought at 52 cents and they're now at around $4. What do we think of the future? So having a look at Goodman Group, and the shares have done very well. Must be a very long-term holder of the stock if they bought at those low prices. But we've recently seen Goodman Group expanding into Japan and the US. And Tim, what about you? What do you think of this?
I think, agree with Michael, well done on investing in it at the right time. It's one that we've never looked at, the reason being that it's never been sufficiently attractive in terms of our quality and performance ratings. And so it's not one that we know a great deal about. Our valuation is somewhat less than the current share price, so it may be that you've done as well as can be expected in terms of your investment in that one. The prospects for future growth don't look as good as the historical prospects for growth.
Okay, we've got another email here. We've got one here from Sam this time, and Sam writes, hi Julie and team, what's your view on a sell price for SLX? So we're having a look at Silex Systems, looking at getting out of the stock. Okay. So Silex, I mean, an interesting company. It's the largest clean technology company that's listed on the Aussie share market, and I think they've got solar technology that they're hoping to take overseas and to take it global. I mean, what's your view on this stock, Tim?
Look, this is another challenging one for us. It's loss-making, and in recent years it looks as though the losses have been accelerating, and it's burning through cash at a pretty rapid rate, although it does have a reasonable cash balance still to go. This is one you're really relying on a turnaround and on some commercial success, which, based on the information I've got in front of me, is very hard to gauge, so I'm afraid I can't add much to this one.
And I guess having a look at technology companies, I mean, there's a lot of research and development, a lot of costs involved, and then there's quite a long wait for cash flow. I mean, any tips in investing in companies like this, Tim?
I think an important principle for investors to keep in mind is to invest in things where they have a level of understanding, a level of insight, some competitive advantage. There's any number of businesses like this that have a great story and the promise of success down the track, and the reality is that a great many of them don't deliver that success and are very unrewarding investments. I think to have a reasonable chance of success, you really do need to have a bit of insight, a bit of expertise into what the company is doing, and some reason to believe in the story.
Okay, so hopefully that helps you out a little bit in terms of Silex Systems, some interesting technology, but of course we're waiting for the cash to flow in. Let's go to our next call. We've got Peter on the line from Queensland. Peter, welcome. What's your question tonight?
I'd just like to know why they keep showing AXA still has a price there, and yet we've been given the AMP dividends, or AMP instead. And one other question. I'd just like to know,
Sure.
should I be, when I get a dividend given to me, should I take it off the price I bought it for, or am I just kidding myself?
Okay, so we're talking to Peter firstly about AXA, and AXA Asia Pacific has actually been merged into AMP, so I shouldn't be seeing the share price for AXA unless you're looking at the international stock there. So that's been merged into AMP now, and of course AMP having a pretty good run up on the back of some of the synergies that are starting to flow through from that AXA acquisition. In terms of the dividend, I guess we've just passed tax time, and it doesn't come off your capital base, so you'll just pay tax usually on your dividends as you would on your income. So you will get taxed as if it was income, not capital, and that's usually the case for an investor. For a trader, it may be a little bit different, and of course the franking credits also giving you a bit of a break in terms of taxation. Anything else in terms of taxation or in terms of AXA, AMP? Do we like AMP? Tim?
I'll avoid giving any taxation advice, as I'm certainly not best qualified to do that. AMP is one of those very well-known sort of blue chip, in inverted commas, companies that we have not invested in. Its financial performance doesn't mark it out as a particularly high-quality business, and the valuation we think is slightly less than the current share price. So it's not one that we'd be attracted to.
Let's just go to one last email. Hi Julia, could your panel give a technical and fundamental opinion on SSM? I think that's Service Stream. We might go to Tim on this one. We've got about a minute left on the show. What do you think?
Okay, just quickly. Service Stream, the issue with Service Stream for me is that ever since 2008, for the last several years, it's earned a return on equity which is below its cost of equity, and that's a real problem in terms of its long-term attractiveness. We think it's probably about fair value, but it's not a business that we would regard as high quality.
And on that note, that's all we have time for tonight.